Welcome back, everyone, and thank you for joining the channel today. In this discussion, we're going to take a deep and detailed look at Applied Digital, a company that has been receiving a great deal of attention from investors as the artificial intelligence infrastructure boom continues to accelerate around the world. Over the last few years, the demand for computing power has increased at a pace that very few people could have predicted. Artificial intelligence models, machine learning systems, high-performance computing workloads, and large-scale data processing are all pushing the limits of existing infrastructure. As a result, companies that build and operate specialized data centers designed for high-performance computing are becoming increasingly important to the global technology ecosystem. Applied Digital is one of the companies attempting to position itself at the center of this massive transformation, and recent developments surrounding the company reveal both significant opportunity and meaningful risk for investors. In this video, we will break down several major developments, including a multi-billion-dollar financing deal tied to the company's Polaris Forge 2 AI computing campus in North Dakota, a strategic collaboration related to semiconductor technology and advanced memory development, changing market sentiment reflected in short interest data, and the broader financial outlook for the company as it attempts to scale its infrastructure footprint during one of the most important technological revolutions of our time. By the end of this discussion, you will have a much clearer understanding of why Applied Digital has attracted so much attention, what the company is trying to accomplish, and why investors remain divided on whether the stock represents a high-growth opportunity or a risky capital-intensive bet on the future of artificial intelligence infrastructure. One of the most significant recent developments for Applied Digital involves a major financing move connected to the company's subsidiary and its ambitious Polaris Forge 2 artificial intelligence computing campus located in North Dakota. In order to support the expansion of this facility and accelerate the build-out of its high-performance computing infrastructure, the subsidiary raised approximately $2.5 billion through the issuance of senior secured notes. These notes carry a fixed interest rate of 6.750% and are scheduled to mature in 2031. Financing of this scale is a major step for a company like Applied Digital because building AI-focused data centers requires enormous upfront capital investment. The Polaris Forge campus is designed to provide the type of advanced computing environment needed for large-scale AI training, complex data processing workloads, and other high-intensity computational tasks. However, financing such projects inevitably introduces additional leverage onto the company's balance sheet. The notes issued to raise the $2.5 billion include strict financial covenants, escrowed proceeds, and a completion guarantee structure designed to provide lenders with additional security and oversight regarding how the funds will be used. These mechanisms are common in large infrastructure financing deals because they ensure that the capital raised will be directed specifically toward completing the intended project rather than being diverted elsewhere within the business. While this financing gives Applied Digital the resources needed to continue expanding its AI computing capacity, it also increases the company's exposure to execution risk. If the project encounters delays, cost overruns, or demand fluctuations, the company will still be responsible for servicing the debt associated with the notes. As a result, the financing both accelerates the company's growth strategy and simultaneously raises the stakes for successful project delivery. At the same time that Applied Digital is pursuing large-scale infrastructure expansion, important developments are also taking place in the broader semiconductor ecosystem that could have long-term implications for AI computing capabilities. A significant partnership announcement involving semiconductor equipment technology and memory development highlights how companies across the technology supply chain are working together to push artificial intelligence hardware to the next level. According to a recent press release, Applied Digital and a major memory manufacturer are collaborating to accelerate the development of advanced memory technologies specifically designed for artificial intelligence workloads. These technologies include advanced DRAM architectures, high-bandwidth memory solutions, and next-generation NAND storage systems that will play a crucial role in supporting future AI applications. The partnership involves engineering teams from both organizations working together on joint research and development initiatives aimed at strengthening the semiconductor innovation pipeline within the United States. By combining expertise in materials science, semiconductor manufacturing processes, and system architecture design, the collaboration aims to improve performance, efficiency, and scalability for memory components used in artificial intelligence systems. The significance of this collaboration becomes clearer when considering the role that memory technologies play in modern AI computing environments. Artificial intelligence models, particularly large language models and complex neural networks, require enormous amounts of memory bandwidth and storage capacity to function effectively. High-bandwidth memory, often referred to as HBM, allows AI accelerators and GPUs to access data much more quickly than traditional memory architectures. DRAM provides the high-speed working memory required for real-time computation, while NAND storage enables the long-term storage of massive training datasets. Demand for these technologies has been growing at an extraordinary pace, driven largely by the explosive growth of AI applications across industries such as cloud computing, scientific research, financial modeling, and autonomous systems. In fact, demand for advanced memory processors has become so strong that management at one major memory manufacturer previously stated that its production capacity was essentially sold out, highlighting just how intense the demand environment has become. Expanding partnerships with equipment providers and technology developers could help increase manufacturing capacity and accelerate innovation cycles, allowing the industry to keep up with rising demand for AI hardware. Another interesting aspect of the partnership is the scope of the collaboration between engineering teams. Rather than focusing on a single product or component, the companies are working together across multiple technological layers. This includes the development of next-generation materials, advanced process technologies, and new architectural designs for memory products used in artificial intelligence computing systems. By approaching the problem from multiple angles, the collaboration aims to produce memory technologies that deliver higher performance, improved energy efficiency, and better scalability. These improvements are essential for supporting future AI workloads, which are expected to become even more computationally demanding as models grow larger and more complex. If successful, these joint research efforts could help strengthen the domestic semiconductor ecosystem in the United States while simultaneously supporting the rapid growth of the AI infrastructure market. While technological partnerships and infrastructure expansion are critical elements of Applied Digital's long-term strategy, market sentiment surrounding the company is also influenced by trading activity and investor positioning in the stock. One metric that analysts frequently examine when evaluating market sentiment is short interest, which represents the number of shares that have been sold short but not yet covered by traders. Short selling occurs when investors borrow shares of a company and sell them in the open market with the expectation that the stock price will decline. If the price falls, the trader can repurchase the shares at a lower price, return them to the lender, and profit from the difference. However, if the stock price rises instead of falling, short sellers can experience significant losses because they must eventually buy back the shares at a higher price. Because of this dynamic, short interest can provide valuable insight into how bearish or bullish investors are toward a particular company. Recent exchange-reported data indicates that Applied Digital's short interest as a percentage of float has declined by approximately 7.21% compared to its previous report. Currently, about 80.34 million shares of the company are sold short. This represents roughly 31.25% of the shares that are available for public trading. When evaluating this figure, analysts also consider the stock's trading volume to estimate how long it would take for short sellers to cover their positions if they decided to close them. Based on the company's current trading activity, it would take traders an estimated 2.82 days on average to buy back the shares required to close their short positions. While the recent decline in short interest suggests that some bearish investors may be reducing their exposure, the overall level of short interest remains relatively high. This indicates that a substantial portion of the market remains skeptical about the company's future performance. Short interest becomes even more meaningful when compared with peer companies operating in similar industries. Analysts often use peer comparison as a way to evaluate how a company is performing relative to competitors that share similar characteristics, such as market segment, size, financial structure, and operational focus. According to data compiled by Benzinga Pro, the average short interest as a percentage of float for companies within Applied Digital's peer group is approximately 8.03%. Compared with this benchmark, Applied Digital's short interest of more than 31% is significantly higher than that of most of its peers. This disparity suggests that investors may perceive greater uncertainty or risk associated with Applied Digital's business model, financial structure, or growth strategy. High short interest does not necessarily mean that a company will perform poorly, but it does indicate that a meaningful portion of market participants are betting against the stock's near-term performance. Another development that attracted attention from investors involved a notable shareholder transaction by one of the most influential companies in the artificial intelligence ecosystem. As of the end of the third quarter of the previous fiscal year, a leading semiconductor company held approximately 7.7 million shares of Applied Digital. At the time, that stake was valued at around $177 million. However, during the fourth quarter, the semiconductor company sold its entire position in Applied Digital. News of this transaction sparked speculation among investors about whether the sale indicated a lack of confidence in Applied Digital's long-term prospects. It is important to remember that large institutional investors frequently adjust their portfolios for a variety of reasons that may have little to do with the fundamental outlook of a specific company. Portfolio rebalancing, capital allocation decisions, risk management considerations, or shifts in strategic focus can all lead to changes in holdings. While some investors interpreted the share sale as a negative signal, others argued that it should not necessarily alter the long-term investment thesis surrounding Applied Digital's role in the AI infrastructure build-out. Despite the mixed signals from market sentiment indicators and institutional trading activity, many analysts remain optimistic about the broader opportunity facing Applied Digital. The company focuses on building and operating high-performance computing data centers specifically designed to support large-scale computational workloads such as artificial intelligence training and inference. As AI adoption continues to spread across industries, demand for the specialized infrastructure required to run these systems is growing rapidly. Training advanced AI models requires enormous amounts of processing power, often delivered through clusters of high-performance GPUs or specialized accelerators housed within purpose-built data centers. These facilities must provide not only raw computing capacity, but also advanced cooling systems, high-speed networking infrastructure, reliable energy supply, and scalable architecture capable of supporting ever-increasing workloads. Applied Digital is attempting to capture this opportunity by constructing large-scale data center campuses capable of delivering the computing resources required by AI developers, cloud service providers, and enterprise customers. The company's strategy focuses on building infrastructure that can support high-density computing environments, which are essential for running AI workloads efficiently. Once these data centers are completed and fully operational, they have the potential to generate substantial cash flows through long-term leasing agreements with customers that require continuous access to computing power. This business model can be attractive because it provides recurring revenue streams over extended contract periods. If demand for AI computing continues to expand as expected, data center operators like Applied Digital could benefit from a sustained wave of infrastructure investment across the technology sector. Financial results from the company's fiscal 2026 second quarter provide some evidence of the strong demand environment surrounding AI infrastructure. During the quarter, which ended on November 30th, Applied Digital reported revenue growth of approximately 250% compared with the same period in the previous year. Such dramatic growth reflects the surge in interest from customers seeking access to high-performance computing resources. However, the company's financial statements also reveal another important aspect of its growth strategy: substantial ongoing investment in expanding capacity. Because building advanced data centers requires significant capital expenditure, the company reported an increased net loss during the same period. These losses were largely driven by the costs associated with constructing new facilities, installing specialized equipment, and scaling operations to meet anticipated demand. For investors, this situation highlights a key characteristic of infrastructure-focused technology companies. Unlike software businesses that can scale rapidly with relatively modest capital investment, data center operators must commit enormous financial resources up front before revenue from new facilities begins to flow. Construction timelines for large computing campuses can span several years, and the return on investment often depends on securing long-term customer contracts once the facilities become operational. As a result, investors considering Applied Digital must be prepared to adopt a longer-term perspective. The company's strategy is based on the assumption that demand for AI computing will remain strong for many years, allowing its infrastructure investments to generate substantial cash flows once projects are completed. Supporters of the company argue that the current financial losses should not necessarily be viewed as a negative sign. Instead, they see them as a natural consequence of aggressive expansion during a period of unprecedented demand for AI infrastructure. From this perspective, Applied Digital's investments today could position the company to benefit significantly as artificial intelligence continues to reshape the global economy. If the company successfully completes its data center build-out and secures long-term contracts with major customers, the resulting revenue streams could potentially justify the large capital investments being made today. However, not all analysts share this optimistic outlook. Some investors remain skeptical about the company's long-term trajectory due to several structural challenges. One concern involves the company's current lack of profitability despite the rapid growth in revenue. Even though sales increased by approximately 250% in the most recent quarter, the business remains unprofitable as it continues to spend heavily on expansion. In addition to operating losses, the company also carries a substantial amount of debt on its balance sheet. Estimates place the company's total debt load at around $2.6 billion, a figure that reflects the capital-intensive nature of building high-performance computing infrastructure. High levels of debt can introduce additional financial risk, particularly if interest rates rise or if projected revenue growth fails to materialize as expected. Servicing debt requires consistent cash flow, and companies that rely heavily on borrowed capital must carefully manage their balance sheets to ensure long-term sustainability. For Applied Digital, the success of its strategy will depend on whether the demand for AI computing capacity remains strong enough to support the company's expanding infrastructure footprint. If customers continue to sign long-term contracts for computing resources, the company could eventually transition from a capital-intensive growth phase into a period of strong cash generation. On the other hand, if demand weakens or competition intensifies, the company may face challenges in achieving the profitability required to justify its large debt obligations. Another factor contributing to investor uncertainty is the inherently capital-intensive nature of the data center industry itself. Constructing facilities capable of supporting high-density computing environments involves not only the physical buildings, but also extensive electrical infrastructure, advanced cooling technologies, high-speed networking systems, and specialized hardware installations. Each new data center represents a major financial commitment that must be carefully planned and executed. Even small delays or cost overruns during construction can have significant financial implications, particularly when projects are financed through large amounts of debt. Despite these challenges, The broader macroeconomic environment continues to support strong demand for AI infrastructure. Artificial intelligence is increasingly becoming a foundational technology across industries, ranging from healthcare and finance to transportation and manufacturing. Companies around the world are investing heavily in AI capabilities to improve efficiency, automate complex tasks, and develop new products and services. As AI models become more sophisticated, the computational resources required to train and deploy them are growing exponentially. This trend is creating enormous demand for data centers capable of delivering the performance and scalability required for advanced AI workloads. Applied Digital's long-term success will ultimately depend on its ability to execute its infrastructure expansion strategy while maintaining financial discipline. The company must successfully complete projects like the Polaris Forge campus, attract and retain major customers, and manage its balance sheet carefully to ensure that debt levels remain sustainable. If these elements come together successfully, the company could emerge as a significant player in the rapidly expanding market for AI computing infrastructure. However, investors should also recognize that the path to that outcome may involve volatility, financial risk, and ongoing uncertainty as the company continues to invest heavily in its growth strategy. As the artificial intelligence revolution continues to unfold, companies like Applied Digital represent an interesting intersection between technological innovation and large-scale infrastructure development. The demand for computing power is unlikely to disappear anytime soon, and the organizations capable of providing the physical infrastructure required to support that demand could play an essential role in shaping the future of the digital economy. At the same time, the financial and operational challenges associated with building such infrastructure make this sector one of the most complex areas for investors to evaluate. Balancing the enormous potential of AI with the practical realities of capital investment, project execution, and financial sustainability will remain a central challenge for Applied Digital in the years ahead. That brings us to the end of today's deep dive into Applied Digital and the key developments shaping its future. If you found this analysis helpful and want more detailed breakdowns of technology stocks, artificial intelligence companies, and emerging investment opportunities, make sure to support the channel. Don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss our latest content. Thank you for watching, and I look forward to seeing you in the next video.